Mohamed El Erian is the Chief Economic Advisor at Allianz. His new book is titled The Only Game in Town: Central Banks, Instability, and Avoiding the Next Collapse. He's chairman of President Obama's Global Development Council, a contributing editor to Financial Times, and the former CEO of PIMCO. He holds a master's degree and a doctorate in economics from Oxford University, and also authored the bestseller When Markets Collide, which won the Financial Times and Goldman Sachs Business Book of the Year. You can manage as a fixed income advisor. This is someone for whom I have a lot of respect and have followed over the years. So it's a great pleasure to have you on our show today, Mohamed.
Thank you, David. Wonderful to be with you.
Listen, first, I want to talk about Janet Yellen in her testimony just a little while ago on February 10th before the House Financial Services Committee. She talked a lot about a slowdown in China, which of course we're all aware of, which is helping to create downside economic risk in our economy, as well as other global economies. Current inflation measures suggest very little pricing strength and very little room for long-term interest rates to increase. So my question is, if the yield curve remains as flat as it has been, or even becomes inverted, will banks and insurance companies resume their previous problems, in your opinion?
So it depends where they're starting from. There's no doubt that banks in particular are facing three elements that are developing a perfect storm, particularly in Europe. First, the interest rate environment. Like you say, we not only have interest rates coming down, but the curve is flattening and could even invert, which means they earn less. Second, those who've lent to the commodity sector and the energy sector have a quality issue on their portfolio. So there's concerns about the quality of the loans they've made. And third, and this is also important, the regulatory environment has changed. So investors have less confidence that if something really goes wrong, there will be support for them. Put these three things together, and this means pressure on banks in particular. And in Europe, it means huge pressures on banks.
Yeah, I agree completely. It makes a ton of sense. And in general, central banks have come under a lot of criticism for their drastic manipulation of markets over the last few years. Question is, will the Fed and or other central banks lose their resolve to squelch this volatility in their particular local markets in the future? Or do you think this practice is
So we have two developments. Yeah, we have two developments. And you're right, central banks realize that they're under criticism, but it's important to remember they didn't do this by choice, but they did this by necessity. Why? Nobody else was stepping in. They have political autonomy, so they felt morally obliged to step in even though they didn't have the right tools. With time, when you don't use the right tools, the collateral damage becomes significant, and that's where we are today. So we're seeing two trends. In the case of the Fed, it is less willing to continue doing this. In the case of the other central banks, the European Central Bank, the Bank of Japan, the People's Bank of China, they're still willing, but less able, they're less effective. So the central bank community as a whole is having a lot more trouble continuing its policy of repressing volatility and intervening with markets.
It's interesting, after the Fed hike in December, I was on a panel on Closing Bell that same day, and I remember that when the Fed statement said that they'd be cautiously raising rates throughout 2016, it seemed completely unlikely to me. And you know, the FOMC, let's face it, certainly has access to more information than I do and almost any other entity. Do you personally think that they believed what they were saying at the time, or perhaps we're just trying to create a lot of optimism and self-fulfilling prophecy of sorts?
So one issue with the Fed historically is that they tend to concentrate on domestic developments. And if you were to look at the US economy in isolation, you would argue that yes, it can support 4 interest rate hikes, which is what they signaled at the time. But if you look at the US economy in the broader context, then you start getting worried. Why? Because you cannot be a good house in a poor neighborhood. And what's happening? The global environment is getting more risky. There's less economic growth internationally, and there's more financial volatility. So if you look at the US in the context of what's happening outside the US, it's very hard to see how they're going to hike interest rates 4 times.
Yeah, well, that's a conversation that you and I could probably spend hours having if we weren't limited by the television show. Tell me, should small investors who are looking for income today, Should they be sitting at home waiting for rates to come back up? Or do you think with the global economic weakness we're seeing today that rates are going to stay low for a long time, so they might be better off just putting money to work in fixed income now versus waiting?
So a lot depends on your starting position. So a few things that investors should keep in mind. One is this volatility will continue. It is not going away. We're coming out of a period of unusually repressed volatility, and now we're going to have payback. So the first thing they should be ready for is wild volatility. Intraday, intra-week, they're going to see a lot of very strange things happening as the system starts to normalize again. The second element they have to remember is when they buy fixed income, they're buying at least two very distinct risks, as you know. One is interest rate risk, and the other one is credit risk.
Of course.
And they have to be careful on the credit risk side. Third, patience is really important. As markets get dislocated, good names and bad names go down together. So a patient investor will have opportunities to pick up good names at low prices. I would be cautious. I would be very measured at this point. I would value the optionality that cash gives me. And I would make sure that I'm not overexposed to volatility.
You and I seem to agree on so many fronts, but maybe because I was smart enough over the years to follow you and to learn from you. So stay with us. We have to take a commercial break, and when we come back, we're going to talk about Mohamed's new book and some predictions and things that are going to help you manage your money better. We'll be right back. This is fun. This is great. 3, 2, 1. But I'd like to take a few seconds and tell you why I decided to write the book entitled Return on Principle. Basically, it all boils down to this. Let's face it, you deserve to live a happy retirement. It's as simple as that. But for many, the subject of money, finance, and math is complicated. Here's a fun fact. Many Americans claim that they'd much rather clean a toilet than calculate a tip in a restaurant. Thank you, I guess. But it doesn't have to be that complicated. Using the 7 core values I outline in my book, you too will be able to build a life based upon the right core principles. Cut. Return on Principle isn't just a book about financial investing, it's about investing in your life. I know for a fact that you're going to love it. Okay, now it's just getting a little weird here. Welcome back. As a fixed income nerd, you can imagine that I have an incredible man crush in a way on our guest today. Our guest we're talking to is Mohamed El Erian. He's the Chief Economic Advisor at Allianz. And now we're going to talk a little bit about his new book, The Only Game in Town, Central Banks, Instability, and Avoiding the Next Collapse. Tell us, Mohamed, what can our viewers learn from your new book? Things that they may not be hearing from a traditional financial advisor.
So the main point of the book is that all that we are seeing in terms of market volatility, in terms of negative interest rates in Japan and Europe, in terms of this very strange blame game between oil and stocks, all these things are part of a much bigger story. And the story is actually quite a simple one. The road that we're on is ending. We will no longer be able to repress financial volatility. We will no longer be able to maintain low but stable growth. We are going to tip. Within the next 3 years, the system is going to tip. Now, what's hard is that there are two possibilities. There's nothing predestined about where we go. We could either tip in a much better place if our politicians respond, or alternatively, it's about recession, it's about huge financial instability. So investors have to realize that we are entering this T-junction, what the British call the T-junction, the road ends. And they have to think about the asset allocation accordingly, which means doing things differently, David.
How about oil? What's your take on what's been happening lately with oil? This is kind of sort of unprecedented.
Yeah, and it's amazing to think that low oil prices have gone from being viewed as a blessing to being viewed as a curse. It's not just a supply and demand issue. If it was just a supply and demand issue, oil wouldn't be where it is today. It'd be higher. It is also that the oil market has lost its seatbelt. It has lost the swing producer, the notion that OPEC and Saudi Arabia would cut production in order to support prices. So the market right now is completely unhinged. Over the long term, if you ask me where's it going to be in 12 to 18 months' time, I'm pretty sure it's going to be higher. But over the short term, we're going to see enormous volatility continue.
Do you think it's another deflationary signal? The fact that oil's been dropping, not as far, because a lot of this is because of the unhingedness that you just described. But in general, do you think it's a deflationary signal as I do?
Yeah, it is a deflationary signal with one qualifier. It has a positive income effect. Why? It's an immediate tax cut. You go to the pump and you have more dollars in your pocket after you filled your tank. So this is an immediate tax cut. It has a deflationary price effect, but it has a positive income effect. The question, as you rightly noted a couple of minutes ago, is are households confident enough to spend this windfall?
Correct. In the last minute we have together today, I'd like to, time flies when you're having fun. I'd like your take on what's happening recently. A lot of advisors, traditional advisors, are saying don't invest in fixed income today because interest rates can only go up. But they miss the whole concept, the offsetting element, which is the risk premium spread. And we just talked in the last segment about risk premium spread. So do me a favor, tell our viewers what your take is on that.
So my take is to be very careful about the risk premium for now. We are going to see pressure. There is no patient capital to step in and stabilize risk premiums in general. But this will create opportunities. Why? Because you get this awful thing called contagion, where good names and bad names are lumped together. So be patient. There will be opportunity to pick up fixed income where the risk premium has moved excessively. So be patient, but this is not an immediate opportunity. This is one that's going to develop over time.
Yeah, and at least investors saw that only 7 or 8 years ago, so it shouldn't be a total surprise. But you're right, the contagion does occur and is an issue for investors. So it's been a pleasure today. I want to let you know that I don't think any less of you for the fact that you gave me the 50-50 answer. Sometimes it is truly 50-50. So thanks a lot for being on our show today.
Thank you.
All right, stay right with us. We're going to take a commercial break. We'll be right back talking more about how you can earn more income conservatively in your portfolio. We'll be right back.